Hey traders, Alex Ong here and welcome back to your Forex Trading for Beginners video series. What we're going to talk about in this video is we're going to talk about how your currency pairs are priced and how we go about making money in the currency market. So understanding the price movements that are actually going to put pounds into your bank account or dollars into your bank account. Now in the previous video, we talked about currency pairs. We talked about the fact that when we're trading, we're taking part in a foreign exchange transaction. So when we're trading the FX markets, we're trading one currency against another. We also talked about the fact that there is a base currency and a quote currency. And we kind of talked a little bit about the pricing of that particular pair. And in this video right here, let's dive more into the detail. So if we take the example of the previous video where we talked about the euro dollar. So we had the euro dollar. Okay, so the euro USD, and we had a price, let's use the price of 1.2000. So the price of the euro dollar is priced at 1.2000. Now what we're interested in, okay, the smallest incremental move of a currency pair is going to be the fourth decimal place, which is known as the pip, okay? Now this is true of all currency pairs apart from the yen pairs. So if you're looking at the Japanese yen, it's a little bit different. It's a bit of an exception, but if you're looking at the yen, so let's say we look at the euro yen, for example, so the euro JPY, and let's pick a hypothetical price of 130.00. You'll see that the pip for the yen is actually the second decimal place. Now with some brokers and with some charting platforms, they will show you a fifth decimal place. So there might be a number over here like that, or a third decimal place in case of the yen. That's something known as a pipep, and essentially that's a fraction of a pip. But when you're looking at your brokerage platforms, let's get rid of these for a moment. When you're looking at your brokerage platforms, okay, and you're looking to take a trade with your brokerage platform and they say, how much currency do you want to trade for this particular trade? Or what if you're in England and you're trading with a spread betting company and you're looking at, what is the size of the position that you want to take? So in the US with a regular broker, you will trade in terms of lots. You'll have a standard lot, a micro lot, or a mini lot, a micro lot, and you even have nano lots now. In the UK, it's actually a lot simpler than that. We're just trading in terms of, a particular position size. So we can actually say the amount that we want to trade per pip. So when we're talking about per pip, we're talking about the movement of this guy over here. So let's say, for example, we believe that the euro dollar is going to go up in value. So that is, we believe that the euro is going to get stronger against the dollar. So we would expect this exchange rate here, 1.2000, to go up. Now, if it did go up in value, let's say, for example, it went up to 1.2100. Okay, well now this has moved 100 pips. So this pip here goes 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, that turns to a 20 and so on and so forth. So this pip here ticks all of these numbers up over here, right? So it goes through, 1, 2, 3, 4, 5, 6, 7, 8, 9. So 120, okay, 12000 up to 12100 is a movement of 100 pips. Now, the way that we make our money is we would put a position size down. So we would say per pip, we want to trade at, let's say, £10. So if we're trading at £10 per pip, like we've got that there, then that would be 100 times 10, which would then give us a profit of £1,000. Okay, that's if the market went from one spot 200 to one spot 2100, and we had bought the market. So we were buying in anticipation of the price moving up. If we thought the price was going to move down, all right, so let's say, for example, the price goes from 1.200 down to 1.1950, like that. Okay, then we've got a movement of 50 pips. So the market has moved from essentially, if you look at it, if you get rid of like these here for a minute, ignore the ones on the side, and you just look at the number that you've got here. So the 4 decimals, or obviously the 2 if you're looking at the yen, you're looking at the movement here. So you can see that this has gone from 2000, essentially 2000, down to 1950, so 1950. So that's a move of what? 50 pips, okay? So there we have a movement of 50 pips. Now, if we were trading again at £10 a point, then we would make £500 for that trade. But it's important to remember that that's obviously if you get the right side of the market. If you have the wrong side of the market, then it would cost you that. That's how much you would lose. So you've always got to look at your risk as well. It's not just about everything that you can make here. You know, you've got to remember that whilst you've got your upside volatility, you've got the potential to the upside, you can also lose money at the same time. So it's all well and good saying, oh, if I can just get those 50 pip movements, I'll be making £500 a time. But remember, you will also be having losses as well. So it's just something to keep in mind there. But essentially, that's how the currency pairs move. So we're looking at the currency pair movement in terms of pips. With most currency pairs, you'll be looking at the 4th decimal place. And with the yen pairs, you'll be looking at the 2nd decimal place. So I hope that helps you a little bit understand the way that the currency pairs move and how you essentially make money in the currency markets. What we'll start to do now is we'll look at the different session times that you can trade at. So when you're actually going to be trading, and then we'll start to dive into some of the analysis techniques and how you actually go about taking trades, putting on trades, and all of that kind of good stuff. Okay, so I hope you enjoyed this video, and I'll catch you in the next video. Take care.